Investing in 2026 is looking very different from the easy money years that many new market participants first experienced. For young investors, that shift is not a reason to step back. It is a reason to get sharper. Higher scrutiny on earnings, changing interest rate expectations, currency swings, and a wider menu of products all mean one thing. The investors who stay disciplined, informed, and flexible are better positioned to navigate the noise. The good news is that the basics of investing still matter. Businesses still need healthy profits, and prices still deserve careful attention. Diversification still can reduce concentration risk, and patience still remains one of the strongest tools in the toolkit. What has changed is the speed of the market narrative. If you are building wealth early, you need a framework that helps you filter noise. You need a framework that helps you make decisions with conviction. Let's look at why young investors need a new playbook. Markets in recent years have been shaped by liquidity, policy support, and strong participation from domestic investors. Looking ahead to 2026, the focus may shift back toward fundamentals. Asset allocation deserves more attention than chasing hot themes. Young investors often start with enthusiasm and then get pulled into headline-driven trades. Treat investing like a long-term skill. Build a plan, review it regularly, and make sure every rupee you invest has a clear purpose. How important is earnings growth for young investors? The answer is very important. Over longer periods, companies with improving earnings can be more likely to reward patient investors. That is why you should learn to look beyond the story and ask, can this business build earnings steadily over time? If the answer is unclear, the investment may deserve a lower priority. High-quality businesses are better for long-term wealth. Strong businesses with improving fundamentals are often better candidates than stocks that only look exciting in the moment. For newer investors, this means reading beyond the stock price chart. Watch revenue growth, margins, and debt levels. Watch the company's ability to convert demand into profit. Sustainable investing starts with business quality. When markets become unpredictable, diversification stops being a theoretical idea and becomes practical protection. Spreading investments across asset classes can help reduce the impact of a single bad call. Diversification does not mean owning everything. It means owning the right mix for your goals and risk tolerance. It also means avoiding the trap of concentrating too much in one theme, one sector, or one trading idea. Multi-asset strategies can be useful because they balance growth and defense. The point is not to eliminate risk. The point is to make sure no single shock derails your financial plan. Now let's talk about global exposure. In a world where currencies can move quickly, young investors with global spending needs should pay attention. A weaker local currency can make imported goods, foreign travel, and overseas education more expensive. If you hold global assets, currency movements can affect returns in ways that are easy to overlook. This does not mean global investing should be avoided. It means it should be understood. A diversified investor thinks in layers: local opportunities, global opportunities, and currency impact. That mindset helps you avoid surprises and choose products more carefully. Finally, why are precious metals still relevant? Gold and silver can sometimes provide a steadier counterweight when markets feel unsettled. They are not meant to replace growth assets like equities, but they may add portfolio balance during tension. They are a layer of protection during periods of inflation pressure, geopolitical tension, or currency weakness. Young investors sometimes ignore precious metals because they do not look as exciting as fast-moving stocks. But their role is not to thrill you. Their role is to help balance the portfolio when things get uncomfortable. The key is moderation. Precious metals are useful as part of a broader allocation, but don't go overboard. Going overboard can also reduce long-term growth potential. It's all about the right balance. In summary, stay disciplined, focus on fundamentals, and build a plan that works for the long term. Investing in 2026 requires a sharper playbook, but the opportunities for young investors remain vast. Start building your smarter portfolio today. Thanks for watching and stay invested.